First of all, good evening to everybody. Welcome to this new webinar. We are gonna talk tonight about something which ideally moves on compared to what we have talked about last time. Last time we have introduced briefly the market microstructure in order to understand properly what kind of information the order flow analysis gives us. So tonight, finally, we'll have a first deep dive into the how can we use these informations given by the order flow analysis, or able to understand from the price microstructure. And so finally, we will understand also the reason of many dynamics, which sometimes we spot on the chart, but we always have asked ourselves why actually they do occur. We will hope, I hope we can have this question answered tonight together. So let's just wait a couple minutes and we are
Yes.
ready to start.
Sorry, I got disconnected accidentally. Welcome to everyone from the trading pit as well. Edoardo, looking forward for another great webinar.
Thank you, Alex. Thank you. I hope you can all see my screen shared. I guess.
Yes, your screen is shared.
Okay, cool. Interesting market today. Well, not exactly today, but over the last few sessions, we had almost all of the drop from last week completely recovered. That actually corresponds a little bit to what we said over a couple of webinars ago when we were talking about low volume areas in terms of volume profile and the way actually they can reject price. This is actually what it happened yesterday after I'm talking about the S&P 500, which we can see here on the chart. After this rise here, the price has started its rejection and its retracement exactly where we had a low volume area. So in this case, volume profile was really useful to determine what a good final point of that upswing could have been. Okay, I think we are ready to start. Tonight, as I was introducing, we will be talking about the concept and the principle of delta. Delta is a variable, as the word suggests, which expresses actually what? It is a difference, okay? It is a, well, it's better to say differential value, okay? And exactly, it represents the difference between the amount of selling, aggressive selling on a specific price move, on a specific price level, within a specific candle. It depends actually by the point of view we actually look at this delta between aggressive buyers and aggressive sellers. So for this reason, it is very important to have a proper understanding of what we have talked about last time in terms of aggressive and passive orders. Because as we said last time, passive orders never meet each other. We will never have a matching between a passive seller and a passive buyer. And as well as for aggressive buyers, they will never have their orders matched with aggressive sellers, or at least that doesn't happen on the very same tick of price, because they always have to interact each other. So we have, just to make a quick recap, and of course, if there are any questions arising from last webinar, please feel free to ask me. We have aggressive buyers, for instance, let's assume buying at a specific price tick, which is this one, 4,300. We will have the aggressive sellers selling at the very, if we take them into consideration at the very same exact moment, at the tick below, 4297.75. Okay, so aggressive seller would sell here in this moment. Aggressive buyers would buy here. So as you can see, there is always a diagonal relation between two different orders of a different sign, one is buying, one is selling, interacting at the very same moment. A diagonal relationship which actually goes like this. This concept is very important because it will be crucial when we will be talking in two webinars about footprint chart. It will be very important to understand when market accelerates, volume is accelerating in one specific direction, and that is also important to understand the aggressiveness of a move. Okay, but it is also on this relationship which the calculation of delta takes place, because actually, let's assume I have in just this auction, okay, in just this auction, 100 contracts bought aggressively. So let's draw them in green. Okay, at the price level of 4,300. If I want to have a calculation of how many actually contracts were traded both in both sides, so a buying side and selling side, at 4,300, I have to take in consideration this 100 here. Those are the both contracts, aggressively bought, of course. And should I take into consideration also the sold contracts at the lower tick? Well, not really, or at least this isn't the way most of the indicators based on delta work. The diagonal relationship is very important in order to understand how market trades in a very specific moment. But if the parameter we want to take into consideration is not the time, but it is the price, the traded price, we have to take into consideration the sold volume at 4,300, right? But in order for selling aggressive sellers to aggressively sell 4,300 price tick, price will have to start buying aggressively at the upper level. So 4,300, 0.25. Okay, there's still a diagonal relationship, but this is another story which we will go deeper on in two webinars. We just need to take into consideration how many aggressive sellers there were on 4,300 and how many aggressive buyers there were at 4,300. So let's assume at the very same, it doesn't matter in which moment we had this discrepancy between buyers and sellers. So let's assume we have here 4,300. $80 aggressive sellers versus 100 aggressive buyers. Delta, in this case, will be minus 20. In order to calculate delta, and the way actually delta-based tools calculate delta is starting from the ask value, so the value of contracts trade on the ask, buying aggressively, minus the contract trades on the bid at the very same level. So it will be 100 minus 80, which gives us minus 20 as a result. Okay, so what that does mean? First of all, sorry, I made a huge mistake. Delta is plus 20. I'm sorry, guys. Let's do this example once again from scratch. $4,300 is the price level. Okay. At this price level, we had 100 contracts bought aggressively. We have 80 contracts sold aggressively. Okay, so if we do this calculation, 100 minus 80, we will have plus 20. Okay, so delta calculated over this price level, it will be positive because, of course, there is a dominance between aggressive buyers over aggressive sellers, and this discrepancy will regard only 20, well, only just 20 contracts. Okay, so delta in this case tells us two informations: who is more aggressive, buyers or sellers, and how really aggressive they are compared to the other side. In this case, we have 20 over an amount of 180 contract exchange in total over that price tick. Is it a lot? It isn't that much. It doesn't matter yet. It's just important to understand a very simple concept. We can calculate delta from different perspectives. We can calculate delta over a single price tick. We can calculate delta based within a specific bar. As you can see here, let's make an example using a footprint chart, which we will be talking about in a couple of weeks, but just to have an example. Those are single prices, single price bars. In this table below, the value being at the middle, it will calculate the delta, the final delta of the entire bar. That means that for every single price that this bar has gone through, we had this net of deltas. Okay, so in this case, taking this bar as an example, that means we have a positive delta of 222. That means that if we sum up all of every single tick the bar has gone through, the overall difference, it will show a dominance of buyers, and specifically for 222 contracts of difference being bought aggressively compared to the contracts being sold. And this is another dimension of delta just referred to the bar. Another way we can also calculate delta, though, is based on a daily perspective. And we will have, in this case, another tool, which is called CVD, which stands for cumulative volume delta. How does this tool work? This is very interesting if you want to use it for detecting how strong a pressure to the upside or to the downside is, especially during trending days. Because the way it works is very straightforward. Every single day, the cumulative delta would start at the beginning of the session, which in this case is midnight GMT +1 time. Okay, it will start exactly at 0. If we look at the cursor here, it starts exactly at 0. Then it goes a little down, it goes a little up, and showing a candlestick chart very similar to the candlestick scheme building price charts. But based on what this chart would create candlesticks based on delta? Well, it is just the cumulative difference between aggressive buyers and sellers. So let's assume at midnight, as soon as the market opens the session, of course, cumulative delta will be 0 because no exchanges were made yet. So it starts at 0. 1 second after the opening, we have 20 aggressive buyers. So the indicator would rise to +20. Immediately afterwards, we have 5 aggressive sellers. So from +20, we're going to have a slight decrease to -15. Because the -5 aggressive sellers would just decrease the number of the initial rise of aggressive buyers. Then after, this is +15, we have additional 20 aggressive buyers stepping in. The indicator will reach then +35. Then suddenly we have 50 aggressive sellers. The indicator will go down to -15 because those 50 contracts selling aggressively would erase all of these 35, and then we have a net of -15 after this micro auction. So cumulative volume delta would just show over the day in every single bar, for every single trade, aggressive trade which is taken, the situation, the evolution of how the cumulative net delta on a daily basis would move. And on the basis of that, it will create candlestick bars showing the way the delta has been moving throughout the day. If we look at that compared to what the price action today was, we can definitely state that normally price tends to correspond to the price that the movement that the price has made roughly tend to correspond to the way the delta has moved. We have a nice but slow rise here, and we have the cumulative delta slowly rising as well. If we look at the value on the right hand side of my cursor, we can see that at the top, the peak of this move, we had 7.5k of positive delta. That means that over that move to the upside, the difference between the net difference, because was trader buying aggressively and those traders selling aggressively, was positive of 7,500 contracts. So this is a nice indicator of what actually the power of the aggressiveness on one side or on each side is. We can also see from this indicator some interesting dynamic, which is specifically when price doesn't really follow the strength of delta, because sometimes we can notice that compared to the chart, we have made this stop corresponding to this peak in volume, okay? But then after, market came down a little bit, tried to make a new high, which actually I would say this purpose kind of failed, because yeah, a new high, the previous high was broken, but slightly broken, couple ticks, and cumulative delta has done roughly the same. A slight break of the previous high and then came back. But what is really interesting to look at is what happened then after. Market made a deeper retracement from this high, given by this high, and then this first move to the downside was retraced back, let's say roughly 50% of it. And what did the cumulative, but didn't make a new high though. What did the cumulative delta do? It made actually a new high, unlike the price chart. So, how can we read this information? Well, read just from the cumulative volume delta perspective, the market tried to rise again with lots of energy, with lots of fuel, considering that the delta has risen from the previous high it had made in a relevant way, with a relevant amount of volume. In fact, the peak of the volume until then, it was 11,000 contract of positive daily cumulative delta. This new attempt to break and make new highs has made a new peak for the day of 14,000 positive contracts, hitting the ask aggressively. That means buying aggressively. But do you remember what did that action correspond to in terms of price move? Well, not that much of a result, or at least nothing compared to the effort the price the volume has done. Do you remember at the first webinars when we were talking about the relationship between effort and result? Effort is given by volume and also by delta, I would say, now that we have more informations in order to state that delta is roughly the same on volume in terms of they both represent the effort and price. The way price moves after this delta, this effort was committed in the market, has created not that much of a result, because here we had a new high, here we didn't have a new high. So how can we read this information in conjunction in each other using delta? Price, despite many traders trading long here and also in an aggressive way, weren't actually able to move price up. They just weren't able to. And why? How is it possible? There were lots of buying here. How come they weren't able to push price higher after such effort? Well, the answer is quite simple, but not obvious, of course. The reason is the only way, despite a lots of amount of aggressive buying being traded in the market, price doesn't follow through, is because there had to be more passive sellers blocking all of that auction. As buyers were aggressively buying, yeah, they were able to make price tick up, tick by tick. But there were also some opposite force acting as a counterpart. As we know that aggressive buyers always have to deal with passive sellers, apparently passive sellers here were stronger. Or at least they were more consistent. They were stronger. Stronger is the right word. They were stronger, and they were able to eventually absorb all of these buying power until a point where a certain stage buyers just gave up. But delta, indicators of delta would just leave a track of this action, even if it has failed. So what kind of information we can achieve from this example here? Buyers are committed, but they are weaker than sellers. So if I were looking to get long here somewhere, it would have been hard to say I have a reason to go to look for a long and actually to stay long after such a divergence. That's the technical term, a divergence. Every time we have a price move not moving accordingly to what the CVD chart tells in a very exact point, that's what we call a divergence. In this case, we have a direct divergence because CVD chart makes a new high with no follow through by price. And we also have the opposite example if we look at the bottom here. As you can see, we have price forming always new low here, new low here, another new low here. What is the CVD telling here in this situation? Unlike market, CVD chart is not making new lows. That's exactly the opposite thing. That means that the market is trying to trend, is trying to maintain its trend, but with no power. It's like sellers have run out of fuel. They are still selling, but not that much. So market is, making new lows, but with lowered energy. So every time we have a divergence, like these two examples here, that's a direct divergence, that's an inverse divergence. Delta actually tells us something, and sometimes it actually predicts something about what is about to happen in the market. In this specific situation, I would say the second example is the clearest, because let's assume we are short. Okay, maybe we have entered short somewhere here, and we are managing our position. Let's zoom out a little bit. The first thing I should be watching is the way delta moves every time market makes a new swing low. So if I'm short here, the first thing I should be looking at is, first of all, is market making a new low? Yeah, well, apparently yes. What happens in the corresponding section of the CVD? Do we have a new low formed? Not at all. We have a double bottom here. So should I hold my position, or should I be warned about this indication? Well, I would say the second one. I am still in time to actually manage my position, but this is something which is telling me that, yeah, market apparently still going down, but sellers aren't really committed to further sell. So this is the opposite situation compared to the one we were talking about here, because here we said that buyers were absorbed by sellers. So despite lots of energy, buyers didn't make it. Here, there's not energy at all. So we can say in a technical term that sellers actually got exhausted. They ran out of energy. And why do exhaustion actually occur? Well, because we are on a price which apparently it is considered to be too low to be selling. As we said, talking about the auction market theory, we have a continuous participation on new highs and new lows only when participants, and in this example, sellers, perceive that price, this price, when they make the new low, as not so cheap. Otherwise, they wouldn't be selling if they perceive it as too cheap. If they think it is too cheap, then yeah, they would quit their selling commitment. So there is lack of participation. This is exactly what this situation here express. If I have a new low or a new high and there is no correspondence in making a new high or low in the CVD, that shows lack of participation. And this is one of the first warning signs that maybe that trend, if we have a trend, is about to stop or sometimes to reverse. And it is actually what it has happened over here. Now, price is now here and it has reached this level. Just for reference, we went back, just to recap something we said about volume profile, we are back to the POC, so the point of control, the point of balance of the entire day, which comes with a bell-shaped, almost a perfect bell-shaped curve. Almost perfect, but still, this is a good point of control in my opinion, because it is exactly in the middle either of the both of the distribution and also in the middle of the value area. So it is a genuine point of balance between buyers and sellers. This was just to recap this concept coming from the volume profile. How did price came back here? With kind of CVD? Well, upswing. So I would say genuine move compared to the previous high we had made earlier. Are we in divergence or are we in convergence? I would say in this case, we don't have that much of divergence showing by the CVD itself, because we have this high, which is a lower high compared to this one. And also here, that's a lower high. So we have a convergence. Well, the way those highs are sloped down is not exactly the same, but this doesn't actually matter. The things which matters the most is when we have a divergence, because this is normal condition. Okay, it's supposed to be that way. Lower highs. Of course, CVD is showing the strength of the main move and the retracement. If this is a retracement of a downtrend, it is a genuine one, because also delta is making so far a lower high. It is when we have divergences that we have something we have to carefully think about, because that can give us important informations in order to understand and sometimes anticipate the end of trends and the end of a move, or maybe just a slowdown of a move. And this is important to help us making our trading decisions, whether we need to take a trade, and therefore we need to assess the overall situation, and some also if we are already in a trade and we are aiming to manage it at the best. So that's another application of delta, of the concept of delta. Let's talk about a further application of the delta we can have. And this is a very powerful indicators provided by Volsys platform, which is delta bars and delta POCs. First of all, you may have noticed that these bars in this chart, but maybe, yeah, it is more visible this one, which is a longer time frame, that's a 60 range. The color coding of the bars might look a little bit weird, okay, because some of you may have noticed that, for example, some bars like this one, it's an up bar since its closing is here when then the new candle starts, when the new candle opens. But if it's an up bar, why does it come with a red color? Well, according to this setting, the color you can see in the delta shows the delta, the overall delta for the bar. So even if I have an up bar, it is possible that the overall delta exchanged, transacted within the bar is negative. And therefore, the bar would come with a red color. That's another divergence. What's the meaning of that? Again, as well as the first example I've made about the cumulative delta, why should I have an up bar with a dominant red delta? That means that despite all of the majority of aggressive traders selling within that bar, that means from where it opened until when it closed, the bar just closed to the upside. That means that all of those sellers, which were the majority of the aggressive traders, the direction where the majority of the aggressive traders were trading, didn't make it to bring the price down. So once again, they were absorbed by apparently passive buyers, being somewhere here as the bar was developing. And this is a very important information because that means that sellers, sorry, went through a battle within that bar, and they have apparently failed that battle. The buyers won the battle. In fact, as you can see immediately after the bar closes, we have a follow through to the upside. An opposite example is here. This bar is green, but that's down bar. How can I tell that? Because the new bar opens here. So that means that's its shadow, means price has gone all the way up to here. Sorry, it opened here, went all the way up here, and then went all the way down to here. Then the bar overcome the 60 ticks of range, which, being that the time frame we are actually analyzed, tell that the bar is supposed to close and form a new different bar. That happens here, so I have a down bar. But the delta, the difference between aggressive buyers and sellers occurred within the bar, comes with the dominance of buyers. Despite that, price went down anyway. As opposed to the example I was making before, this bar shows that there was a hard fight between buyers and sellers, but apparently buyers have lost the battle and sellers won the battle. Delta, in this case, show us what the most strength in which direction aggressive traders were more aggressive. And the price result, the direction the bar closes, give us the result. But we have, in this information given by the delta, the indication of what the effort was. And in such cases, like this bar or the previous red bar we were talking about, we have a result which is in complete divergence compared to the effort of volume, of aggressive volume, the delta. There are plenty of examples like this. Of course, this is a 60 range chart, so that's representative of a longer term price action. And maybe some of you are not used to consider a range chart, but actually we can have the very same identical representation also on minute chart, time-based chart. Let's just make an example here with a 5-minute chart. That's a little bit harder to detect. In my opinion, range bars are easier to spot these divergences, but that's a nice example. Over these two tiny bars, we have strong delta, strong green delta. So that means that buyers are pushing a lot for price to move up. Okay, and compared to aggressive sellers, they are in dominance. But actually, what happens in terms of price reaction? Well, in the first bar, it tries to go up. It fails immediately, though. We have a closing of the candle creating a low, a, a shooting star. Okay, what according to the candlestick pattern is called a shooting star. So we can say that the attempt of making a new high has failed, is failing, even though there was the dominance of delta was positive. So there was a proper push of volume to this in this attempt of making new highs. Then the following bar is still comes with the dominance of buyers. The bar is still green according to the delta color. But actually, the second bar achieves even less than the previous bar has achieved, which was kind of a poor result anyway, but in this case, it was even worse. This situation leads to a nice drop. Something similar has happened here. Another bar making a nice tail here on the upper part of the candle, comes with a very nice green delta, but there is no follow through. Next bar comes with a negative delta with a follow through, because the bar here, next bar, is red in terms of delta, and it closes right at the very low of the candle. So we have red delta closing at the low. That means that, yeah, delta is red, but also price is following through, is giving result to that effort of negative delta. And if it comes after a discrepancy between volume and delta, definitely that makes sense. Something else, another further information based on that, comes from the bar POCs. Bar POCs are the point of controls referring to the single bar. So we have talked about point of control referring to the daily volume profile, composite volume profile, market profile, as the point where the most volume was traded within that period. Okay, a bar POC is the point of control for that bar. That means within that bar, the point of control is the point where inside that bar we had the biggest amount of volume traded. And this indicator would just make a small rectangle here where actually within the bar, within every single bar, we had the highest amount of transactions, which is nice because it tells us where in which part of the bar, in which portion of the bar we had the most participation of volume of traders. But also we have an additional information. The color of every rectangle shows only the dominant delta for that POC. So it would tell us if that POC, being already an important and interesting reference point, was more traded aggressively buying or selling. Of course, green rectangle shows a POC with the dominance of buyers. Red POCs show POCs with the dominance of aggressive sellers. And this is a further information of interesting information which can be added up to the analysis to the example I was making earlier, like here, up bar, green delta, no result, same thing here. And on top of that, we also have the most traded volume of the candles, of those two candles with a buying dominance. That means that the failure of that delta pushing the price, attempting to push price higher, is even more significant. Because it is a delta confirmed also by the most traded level of the candle. And that level was long. That level came with a majority of buyers. So it counts even more to determine that there was a massive attempt here to push price higher, which have failed. It's not that just a few minor levels coming with the majority of delta, which somehow have influenced the overall delta of the bar. It was positive also the POC for the entire bar, so the level where we had the most transactions. So it has to be a reliable reading of delta in that situation. In fact, if we look at that, still in the same context, we can see that then the next bar comes with a red delta as a follow-through, well, a satisfactory follow-through, since the closing is at the low, but also the color of the POC shifts from buying dominance to selling dominance. So it is a further information going in accordance to the reading we were having over the last two bars. And by looking at things in this way, you can start building a context. You start building a narrative of price given by volume, telling you that here buyers are getting really, really weak, or at least weaker than they used to be here when they made this nice push to the upside. Coming, of course, with a stronger delta. Also, the shading of the candle tells you how actually strong that delta is. Of course, a dark green with the blue, well, this is my color coding, but of course you can customize your own if you're using Volsys platform. A darker green with a blue filling inside means that the delta for the candle is bullish, is strongly bullish. If it's light green, like for example this, it is lightly bullish, but not so much. And same things actually for the red. The stronger the red, the stronger the effort to downside. This is the first application of the order flow concepts we can have in order to uh, contextualize better our analysis. So, for example, just to put things together, was a short trade nice here? Yeah. Why? Because of this situation, but also because we were slowly getting back to the fair value in terms of volume profile, getting back to the POC, the point of balance. We were rejecting actually the external area of the value area. And exactly there, we could spot, looking at delta, this weakness of buyers and sellers then stepping in. Something similar has happened over here at the very high of the day. We were even higher and we were even farther from the point of control. So we could have determined that that was a proper premium prices area where responsive selling is more likely to be happening, and order flow just would confirm this scenario. Order flow is basically a confirmation tool. Either if you need to take a trade, either if you need to manage your trade, or if you just don't want to trade it, you can still use it as just a further analysis tool. Is price here? It was this high occurred right at the opening, right? 3:30 p.m. the cash opening. Is it more likely to be happening a long scenario or a short scenario? Well, after such a struggle from buyers here on a premium area, I would say for the day it was definitely more likely a short scenario. So order flow can be used in all of these three ways. Well, I hope everything was clear about delta. Of course, if you have any questions, please feel free to ask me. Next week, we will go even deeper into that concept using delta to detect what absorption and exhaustion, but also momentum phases are according to the proper delta analysis. So a step further into the order flow analysis, and maybe we will introduce a little bit also the footprint chart, which is one of my favorite tools for the order flow analysis. Yes, recordings of September sessions are available at the Trading Page channel on YouTube. I should have if you give me just 1 second, I will paste the link here in the chat. Here it is. In the chat, you can see the link where you can find all of the recordings of every past webinars we had. And also, I would like also to write down here in the chat my email address in case you want to ask me something. Here it is. Okay, so guys, thanks again for your participation and for your interest in the topics we are gonna go through episode after episode. I wish you a good continuation, a good night, and see you next week, same time, moving on with our course curriculum. Okay, thanks again, and have a good evening.